In 1204, a fleet of wooden ships sailed not toward the Holy Land as promised, but toward Constantinople. When the looting ended, something far more valuable than treasure returned to a tiny lagoon city in the Adriatic. That city had no farmland, no forests, no iron mines, and no army worthy of the name, yet within 2 centuries it would control more wealth than kingdoms 10 times its size. The secret was not what they stole from Constantinople, but what they invented afterward. This is the story of how Venice became the first city in history to function as a bank, and why the financial systems they created 600 years ago are still controlling your money now in ways you have never been told. The real beginning goes back further than Constantinople, back to a time when Venice was nothing more than a refuge for people fleeing barbarian invasions on the Italian mainland. These refugees had nothing but their wits and the brackish water surrounding them. Within a generation, they understood that survival meant trade. They could not grow wheat, so they harvested salt from the shallow lagoons, scraping white crystals from wooden platforms while the smell of brine filled their lungs and the Adriatic wind cracked their skin. They could not raise cattle, so they became the bridge between the Byzantine Empire in the east and the fractured kingdoms of Europe in the west. By the 9th century, Venetian merchants were sailing to Alexandria, to Antioch, to every port where fortunes could be made. But here is the critical detail that most histories overlook. Trade on this scale created a problem that had never existed before, a problem so immense that solving it required inventing entirely new systems of managing wealth. Picture a Venetian merchant named Marco in the year 1100. He wants to buy pepper in Alexandria, transport it across the Mediterranean, and sell it in Bruges. The journey takes months. He needs to pay Egyptian suppliers in gold coins they will accept, pay his ship crew weekly, bribe harbor officials in a dozen ports, and somehow keep track of profits and losses across transactions happening in different currencies, in different seasons, in different political climates. He cannot carry enough gold to cover all these costs because pirates would murder him before he left the harbor. He cannot rely on letters alone because trust between strangers across vast distances simply did not exist yet. This single problem, the problem of moving value across time and space without physically moving metal coins, forced Venetian merchants to create something the world had never seen. They created banking. The first great innovation was the colleganza, a contract structure that allowed multiple investors to pool money for trading voyages while limiting their liability to only what they contributed. If Marco invested 100 ducats in a voyage and the ship sank, he lost 100 ducats, not his house, not his family's future, just the amount he chose to risk. Before this, a single failed voyage could destroy generations of accumulated wealth. Entire families had been reduced from merchant nobility to beggars because one storm caught one ship on one unlucky night. After the colleganza, merchants could take calculated risks knowing that disaster would not cascade into total ruin. It meant that ordinary merchants, not just the wealthiest families, could participate in high-risk ventures. It spread risk across dozens of investors, which meant more ships could sail into waters where pirates waited, more goods could move through dangerous territories, and more wealth could be created for everyone involved. The colleganza was a direct ancestor of the modern limited liability corporation, invented by Venetian merchants roughly 800 years before the East India Company received its royal charter. But the colleganza was only the beginning. As trade volumes increased, Venetians faced an escalating trust problem. If you made a deal with a merchant from Genoa in the port of Acre, how could you guarantee he would pay what he owed when you returned to Venice months later? Imagine Marco deposits 500 ducats with a Venetian banker. The banker hands him a single piece of paper. Marco sails for 2 months across dangerous waters, surviving storms and avoiding pirates. In Constantinople, he hands that paper to a stranger he has never met, and that stranger gives him gold. No coins ever left Venice. The 2 bankers settled their accounts later, canceling out debts, and only transferring the net difference. This was the birth of the clearing system, the same principle that allows your bank to process millions of transactions every day without trucks full of cash driving between branches. The Venetians figured this out in the 13th century using paper, ink, and an elaborate network of trust relationships that stretched across continents. They created a payment processing network before electricity existed. The center of this network was the Rialto, a district in Venice that became the financial hub of the entire Mediterranean world. Imagine a single bridge crossing the Grand Canal, and surrounding that bridge, a cluster of buildings where bankers sat at wooden tables called banchi, which is where the word bank actually comes from. Every morning, merchants from across Europe and the Middle East gathered to exchange currencies, negotiate loans, settle debts, and gather information about prices in distant markets. The Rialto functioned like the New York Stock Exchange, the Federal Reserve, and Bloomberg Terminal all combined into one physical location. A drought in Egypt that damaged the wheat harvest would be reflected in grain prices at the Rialto within weeks. News traveled through merchant networks faster than any government messenger could ride. The Venetians understood something that most modern investors still struggle to grasp: information itself has value, and controlling the flow of information is often more profitable than controlling the flow of goods. That principle would make Venice untouchable for centuries. If you want more stories about how money actually works, subscribe now, because this channel covers what others miss. Now here is where the story gets stranger. Geography alone did not explain Venice's dominance. Genoa had similar advantages and remained Venice's bitter rival for centuries without matching its financial sophistication. What Venice had that no one else did was a government that thought like a bank. The Venetian state itself was structured like a corporation, with shareholders, dividends, and a chief executive called the Doge, who was elected by merchant families rather than inheriting power through blood. Every major decision was made through the lens of profit and loss, rather than feudal honor or religious obligation. When the Fourth Crusade was diverted to Constantinople, it was not because of holy zeal, but because Venice was owed money by the Crusaders and decided to collect. They literally repossessed a crusade. That ruthless financial logic created courts that enforced contracts impartially, even when powerful families tried to cheat and lost everything in the ruling. It created archives where documents were stored for decades, dusty rooms filled with thousands of contracts that could be referenced in disputes generations later. It created notary systems where agreements were recorded by neutral officials who served as witnesses to transactions between strangers. Financial innovation requires trust, and trust requires predictability. Venice provided that confidence through institutions the merchant class controlled and designed for their own benefit. In 1271, Venice faced a crisis that would have broken lesser states. The city had been at war with Genoa, and the treasury was exhausted. Ships needed repairs that could not be funded. Sailors demanded wages that could not be paid. A merchant named Andrea Dandolo watched the council debate for hours about how to raise funds without triggering revolt among the families who actually controlled the city. His own fortune was tied to the outcome. 3 generations of his family had built trading relationships across the eastern Mediterranean, and if Venice defaulted on its obligations, those relationships would collapse. Foreign partners would refuse Venetian credit. Ships would sit idle in the harbor. Everything his grandfather had started would end with him. The solution they invented that night would reshape finance forever. Rather than raising taxes, Venice created the forced loan. Every wealthy citizen was required to lend money to the state based on their assessed wealth, and in exchange, they received bonds called prestiti that paid 5% annual interest. These bonds could be bought, sold, and inherited. A secondary market quickly emerged where prestiti traded based on expectations about future payments and the financial health of the Venetian state. This was the first real bond market in history. It established that government debt could be a tradable asset, that interest rates reflected collective judgment about creditworthiness, and that ordinary citizens could hold stakes in their government's financial future. When you hear about treasury bonds today, about yields rising or falling based on economic conditions, you are hearing echoes of decisions made in Venice 700 years ago. The bond market created something subtle but transformative. It gave Venetians a shared interest in government stability. If you owned Prestiti, you wanted Venice to win its wars and maintain its trade routes because your personal wealth depended on it. In feudal kingdoms, the interests of rulers and subjects frequently diverged. Kings wanted to extract as much wealth as possible, while peasants wanted to keep as much as possible. But in Venice, a critical mass of citizens had financial stakes in government success, which created stability that other Italian city-states constantly lacked. Florence lurched from crisis to crisis as factions battled for control. Milan fell under tyrant after tyrant, each one promising order and delivering chaos. Venice maintained the same basic governmental structure for 500 years, and the bond market was a major reason why. If you know someone who would find this history useful, send them this video. These ideas about risk, trust, and institutional design still shape every financial decision we make today. The Venetians added maritime insurance to their arsenal of financial tools, and to understand why this mattered, consider what happened without it. A merchant named Pietro invested his entire fortune in a ship carrying silk from Constantinople. He had spent years building relationships with Byzantine suppliers. He had borrowed from relatives to finance the cargo. Everything he owned floated on that wooden hull. 3 days from Venice, a storm drove the vessel onto rocks off the Dalmatian coast. Pietro lost everything. His children grew up in poverty. His name was erased from the merchant registers. His wife's family refused to speak of him. This was not unusual. This was ordinary. Every successful merchant knew families destroyed by a single unlucky voyage. Now imagine the alternative. Venetian underwriters would accept a premium payment in exchange for promising to cover losses if a ship failed to return. These contracts were legally enforceable and standardized to the point where premiums reflected actual risk. A ship sailing a known route during calm summer months paid lower premiums than one attempting a dangerous winter crossing into contested waters. Pietro could have paid a small percentage of his cargo's value and slept soundly knowing that nature's cruelty would not destroy his family. This pricing of risk transformed uncertainty from a paralyzing obstacle into a calculable cost that could be factored into business decisions. When you buy car insurance or health insurance today, you are participating in a system whose fundamental logic was established by Venetian merchants protecting their cargo from pirates and storms. There is another factor historians sometimes overlook: the Venetian approach to information control. The Council of Ten, one of the key governing bodies, operated in near total secrecy. Its deliberations were never recorded publicly. Its members were sworn to silence under penalty of death. Venetian diplomats sent detailed reports about the finances, military strength, and political weaknesses of every kingdom they visited. These reports were archived, analyzed, and used to inform policy decisions that affected trade across the entire Mediterranean. Venice essentially ran an intelligence agency centuries before modern nation-states invented the concept. When the King of France was secretly negotiating loans he could not repay, Venice knew before his own bankers did. When the Mamluk Sultan was preparing to raise tariffs on spice shipments, Venetian merchants had already adjusted their routes and stockpiled inventory. They knew what prices were doing in markets their rivals had never heard of. They anticipated currency fluctuations based on political developments that had not yet become common knowledge. All of this translated into better trading decisions and higher profits compounding year after year. Everything the Venetians built depended on one geographic fact: the Mediterranean was the center of world trade. When that fact changed, everything else crumbled. In 1453, Constantinople fell to the Ottoman Turks. The Ottoman Empire consolidated control over the eastern Mediterranean and began squeezing Venetian trade routes with taxes and attacks. Venice fought exhausting wars that drained treasure while producing no lasting gains. Each decade, the cost of doing business in traditional markets increased, but the killing blow came from an unexpected direction. In 1492, Columbus reached the Americas. In 1498, Vasco da Gama sailed around Africa to India. Suddenly, it was possible to access Asian goods without going through the Mediterranean at all. Portuguese ships could sail directly to the source and transport goods to Atlantic ports that had previously been irrelevant backwaters. Within a generation, the economic center of gravity shifted from the Mediterranean to the Atlantic. Lisbon, Amsterdam, and eventually London became the new hubs of global commerce. Venice remained wealthy by historical standards, but it was no longer the cutting edge. The financial innovations that had made Venice dominant were adopted and improved by competitors who had access to vast wealth flowing from the Americas. The Venetians themselves saw what was happening. There are surviving documents from the late 15th century where officials discuss the threat posed by Atlantic routes, where they debate whether Venice should attempt its own voyages of exploration. But the city was locked into its existing infrastructure, its existing relationships, its existing way of doing business. The skills that made Venetians masters of Mediterranean trade did not translate to oceanic navigation. The partnerships that generated profits in Alexandria and Constantinople were useless when the action shifted to Brazil and the Indian Ocean. Venice had optimized too effectively for one world, and could not adapt when that world changed. What Venice left behind is staggering. When historians trace the genealogy of modern finance, the threads lead back to that collection of islands in the Adriatic. The insurance contracts drafted at the Rialto evolved into the Lloyd's market in London. The government bonds first issued in Venice became the model for British consols and American Treasury securities. The double-entry bookkeeping that Venetian merchants perfected became the universal language of accounting still used by every corporation on the planet. The principle of limited liability was codified into law throughout Europe and America, making possible the corporations that dominate our economy today. Even the concept of a financial market as a specific place where buyers and sellers gather to discover prices was formalized at the Rialto before spreading to Amsterdam, London, and New York. Think about what this means. A city of 150,000 people, working with technology no more advanced than paper and ink, created institutional innovations that still govern trillions of dollars in transactions every day. They figured out problems humanity had never faced before, problems about trust, risk, time, and distance. And their solutions proved so effective that we are still using them 6 centuries later. Financial innovation is not primarily about technology, but about institutional design, about creating rules and structures that allow strangers to cooperate profitably. Venice declined slowly, gracefully, over centuries. The city transitioned from being a place where the future was invented to being a place where the past was preserved. The Venetian oligarchy protected their wealth and status for generations, even as their relative importance diminished. They avoided the revolutions that consumed France, the civil wars that ravaged England. They optimized for stability and comfort rather than growth and influence, and by that measure, they succeeded. But the cutting edge moved elsewhere, and the institutions they created found new homes in cities better positioned to exploit the opportunities of the Atlantic world. Here is the question I want you to answer in the comments. Are there parallels today? Are there cities or institutions that have optimized so perfectly for current conditions that they cannot adapt to coming changes? New York remains the financial capital of the world, but cryptocurrencies and decentralized finance are creating pressures that look eerily similar to what the Venetians faced when Portuguese ships rounded the Cape of Good Hope. Traditional retail giants that mastered physical stores now struggle against digital competitors who never needed a single storefront. Venice did not fail because of mistakes. Venice was simply too good at one thing to become good at something else. Understanding how that happened might help us recognize similar patterns unfolding now. The next time you check your bank balance or hear about bonds trading on the news, remember you are participating in systems first sketched out by merchants sitting at wooden tables on a muddy island, dreaming of pepper and profit while inventing the future of money one contract at a time.